Silver just hit $79. Let that number sit with you for a moment. Not because it's exciting, but because it's dangerous. Markets don't whisper before major shifts, they signal. And silver at this level isn't a celebration. It's a warning flare shot straight into the sky of global finance. When a monetary metal surges this hard, this fast, it's not chasing profits, it's fleeing risk. And history is very clear about what happens next. For years, technology stocks have been priced for perfection. Infinite growth, endless liquidity, zero consequences. But silver doesn't lie. Silver moves when confidence breaks. It moves when capital no longer trusts paper promises, forward guidance, or political assurances. At $79, silver is telling us that the system is under stress, and tech, the most leveraged in valuation, sensitive sector on Earth, is standing directly in the blast zone. Here's the uncomfortable truth most analysts won't say out loud: tech stocks don't crash because innovation stops. They crash because liquidity stops. Rising silver prices reflect tightening monetary conditions, currency debasement fears, and a silent exit from risk assets. When capital chooses metal over momentum, over narratives, over growth projections 20 years into the future, it's because faith in stability is evaporating. And tech stocks are built entirely on that faith. Governments will tell you they have tools. They will promise control, stability, soft landings. But silver exposes limits. It exposes the ceiling of monetary power. When real assets rise while policymakers speak calmly, the market is voting against those words. $79 silver says stimulus no longer works the way it used to. It says debt has reached a psychological breaking point. It says confidence can't be printed. And when that realization hits, tech valuations don't gently adjust, they reprice violently. High multiples collapse under higher rates, weaker demand, and shrinking margins. Capital rotates out of speculation and into survival. This isn't theory. This is pattern recognition. Every major shift in monetary history was preceded by a move in hard assets that most people ignored until it was too late. This moment is not about fear. It's about awareness. Silver at $79 is not the end of a cycle. It's the exposure of one. It's the market reminding us that gravity exists, that limits are real, and that narratives cannot override math forever. Those who understand this don't panic. They prepare. They reposition. They stop listening to comfort and start watching signals. Silver at $79 is not a speculative spike driven by excitement or short-term momentum. It is a calculated movement of capital seeking safety in an environment where confidence is quietly eroding. When money migrates into silver at this scale, it is responding to macroeconomic pressure, not chasing upside. This is the same behavior observed during periods when investors begin to doubt the durability of currencies, the credibility of fiscal discipline, and the effectiveness of monetary policy. The market is not celebrating silver, it is escaping risk, and that distinction changes everything. Throughout financial history, silver has acted as a pressure gauge rather than a profit trade. It rises when trust weakens, when inflation expectations harden, and when the gap between official narratives and economic reality widens. The speed and magnitude of this move signal urgency. Capital does not reposition this aggressively unless it perceives structural risk ahead. The hook here is simple, but powerful: silver is moving before equities react, and markets that ignore early signals rarely get a second warning. Unlike equities, silver does not rely on earnings projections, buybacks, or policy promises. It responds to real interest rates, currency debasement, and systemic stress. At $79, the message is unmistakable: real yields are insufficient, purchasing power is under threat, and paper claims are losing appeal. This shift reflects institutional behavior, not retail enthusiasm. Large pools of capital move quietly and early, and silver has historically been one of their first destinations when uncertainty rises. What makes this moment especially critical is the timing. Silver is rising while risk assets remain elevated and policy communication remains calm. That divergence is where danger lies. When defensive assets strengthen without visible crisis headlines, it suggests that informed capital is positioning ahead of an adjustment that has not yet been priced in. This is how market transitions begin, not with panic, but with preparation. The real hook investors must confront is this: silver does not need fear to rise, it needs doubt. Doubt in debt sustainability, doubt in fiscal restraint, doubt in central banks' ability to normalize without breaking something. At this price level, silver is broadcasting that those doubts are no longer theoretical. They are being acted upon. Capital flight does not announce itself with alarms. It shows up as quiet accumulation in assets that have survived every monetary experiment in history. Silver at 70, $9 is not reacting to yesterday's data. It is anticipating tomorrow's consequences. Those who understand this recognize that the move is not about where silver has been, but about what the broader financial system is about to face. High, multiple technology stocks appear resilient on the surface, but structurally they are the most fragile assets in a tightening financial environment. Their valuations are built on assumptions that stretch far into the future: steady revenue expansion, low discount rates, and uninterrupted access to cheap capital. When those assumptions hold, prices soar. When even one begins to crack, the entire valuation framework destabilizes. The hook investors often miss is that tech does not need a recession to fall. It only needs a shift in the cost of money. At elevated multiples, the present value of future earnings becomes extremely sensitive to changes in interest rates and liquidity conditions. A modest rise in real rates or a subtle withdrawal of liquidity can erase years of projected growth overnight. This is not market panic, it is math reasserting itself. As silver rises and signals tightening conditions, the implied message is clear: the discount rate is moving higher, whether policymakers acknowledge it or not. For long-duration assets like tech stocks, that shift is lethal. Another critical vulnerability lies in dependence on narrative rather than cash flow. Many technology firms justify premium valuations through forward guidance, platform potential, or market dominance stories that assume continuous economic expansion. When liquidity tightens, narratives lose power. Investors begin demanding profitability, resilience, and balance sheet strength instead of promises. This transition happens abruptly, and when it does, stocks priced for perfection experience rapid multiple compression, not gradual adjustment. There is also a feedback loop that amplifies downside risk. As technology stocks decline, passive investment flows reverse, volatility increases, and risk models force further de-leveraging. Because tech represents a significant share of major indices, weakness in this sector transmits stress across the entire market. What begins as valuation recalibration quickly becomes systemic pressure. The hook here is uncomfortable, but true. Tech's dominance makes it both the engine of rallies and the trigger of broad sell-offs. Perhaps the most overlooked factor is capital rotation. Rising silver prices reflect a preference for certainty over growth, for preservation over expansion. When capital chooses tangible assets over future-based valuations, technology stocks are the first to be re-evaluated. This is not a judgment on innovation, it is a reassessment of risk. Markets do not abandon tech because it stops being useful, but because it becomes mispriced under new financial conditions. The deeper message is that high, multiple tech stocks are not inherently flawed. They are simply incompatible with environments where liquidity is constrained and confidence is selective. When the cost of capital rises and risk tolerance contracts, valuation gravity returns. And when gravity returns to markets that have floated on cheap money for years, the adjustment is rarely gentle. Liquidity tightening rarely announces itself with dramatic headlines or emergency meetings. It begins quietly, almost invisibly, in the plumbing of the financial system. Funding costs edge higher, risk premiums widen, and access to cheap capital becomes selective rather than universal. Markets can appear stable during this phase, but beneath the surface, repricing has already started. The hook most investors miss is that crashes are not triggered by fear. They are triggered by the absence of liquidity when it is suddenly needed. When liquidity contracts, asset prices are forced to stand on their own fundamentals rather than on excess cash searching for returns. Over the past decade, abundant global liquidity compressed volatility and inflated valuations across risk assets, especially equities. As that tide recedes, correlations rise and diversification benefits disappear. This is when repricing accelerates, not because investors want to sell, but because they must. Margin requirements increase, refinancing windows narrow, and leveraged positions unwind in sequence rather than in isolation. Technology stocks feel this pressure first and hardest. They are deeply embedded in the liquidity cycle due to their weighting in indices, popularity in passive funds, and prevalence in leveraged strategies. As conditions tighten, even small outflows can create outsized price movements. Liquidity is no longer a cushion, it becomes a constraint. The market hook here is brutal in its simplicity. Assets that rose the most on easy money fall the fastest when money tightens. Silver's strength in this context is not coincidental. It reflects the same liquidity dynamics playing out in reverse. As risk assets lose support, Capital migrates toward instruments that do not depend on continuous credit expansion. This migration reinforces tightening conditions by reducing the pool of capital available for speculative investments. Liquidity does not vanish, it relocates. And when it relocates away from equities, repricing becomes unavoidable. Another overlooked aspect is policy transmission lag. Central banks may pause or signal accommodation, but liquidity conditions respond to balance sheets, collateral quality, and risk tolerance, not speeches. By the time tightening is acknowledged publicly, markets have already adjusted privately. This delay is what makes liquidity-driven repricing so violent. Investors realize simultaneously that support they assumed was permanent is no longer present. The real danger emerges when liquidity tightening intersects with elevated valuations. In such environments, there is no margin for error. Earnings disappointments, geopolitical shocks, or policy missteps become catalysts rather than causes. Liquidity sets the stage, events merely pull the trigger. When this mechanism activates, risk assets do not decline in an orderly fashion, they reprice in clusters, feeding volatility and reinforcing defensive positioning across markets. When silver rises sharply while policymakers project calm and control, markets are revealing a growing gap between official confidence and private belief. Monetary policy is built as much on credibility as it is on tools, and silver has long served as a silent referendum on that credibility. At elevated levels, it signals that investors are beginning to question not just policy direction, but policy capacity. The hook here is subtle yet powerful. Markets are no longer asking what central banks intend to do, but whether they are still able to do it. Modern monetary frameworks rely on the assumption that inflation can be managed, debt can be rolled indefinitely, and economic slowdowns can be softened without systemic cost. Silver's advance challenges that assumption. It reflects expectations that inflation pressures may persist longer than acknowledged, that fiscal deficits are becoming structurally embedded, and that currency stability is increasingly dependent on confidence rather than fundamentals. When confidence weakens, policy effectiveness diminishes, regardless of intent. A key limitation exposed by rising silver is the narrowing room for maneuver. Aggressive tightening risks destabilizing debt, heavy economies, and financial markets, while renewed easing risks accelerating currency debasement and inflation expectations. This is the trap. Silver prices rise when investors perceive that every policy option carries unacceptable trade-offs. The market hook is this: silver is pricing policy paralysis, not policy failure. Another signal embedded in silver's strength is skepticism toward forward guidance. Central banks attempt to shape expectations through communication, but metals respond to outcomes, not words. When silver rallies alongside reassurances, it suggests that investors are hedging against the possibility that guidance will be revised under pressure. This disconnect often precedes volatility, as markets are forced to reconcile optimistic narratives with tightening financial realities. There is also a global dimension that amplifies this signal. Governments are managing record debt levels in an environment of geopolitical fragmentation and slowing growth. Monetary coordination becomes harder, and fiscal discipline becomes politically costly. Silver, traded globally and unconstrained by national policy, reflects these broader risks more honestly than domestic indicators. Its rise implies that investors are seeking assets beyond the reach of policy intervention. The deeper implication is that markets are beginning to test the boundary of state control over economic outcomes. Silver does not reject government authority outright. It questions its limits. At higher prices, it suggests that trust in centralized solutions is weakening and that risk is being reassessed outside official frameworks. When this shift takes hold, asset pricing changes character, and policy reactions become less predictable and less effective under stress. A sustained breakout in silver is rarely an isolated commodity event. It represents a broader reallocation of capital away from growth, dependent narratives, and toward assets perceived as resilient under stress. This rotation does not happen because investors suddenly lose interest in innovation or productivity, but because the risk-reward balance shifts decisively. The hook investors often overlook is that markets rotate long before headlines change, and by the time the rotation becomes obvious, valuations have already adjusted. Growth narratives thrive in environments where capital is cheap, expectations are optimistic, and time is treated as an ally. Hard assets, by contrast, thrive when uncertainty rises and time becomes a liability. When silver attracts sustained inflows, it signals that investors are prioritizing preservation over projection. This transition undermines sectors whose valuations depend on distant earnings and uninterrupted expansion. The market is not rejecting growth, it is repricing the cost of waiting for it. Capital rotation also alters market structure. As funds move into hard assets, equity market participation narrows. Breadth weakens, leadership concentrates, and momentum becomes fragile. Technology stocks, which often dominate index performance, lose incremental buyers just as selling pressure increases. The hook here is structural, not emotional. Markets do not need panic to fall. They need only an imbalance between buyers and sellers. Rotation creates that imbalance quietly and persistently. Another critical element is the change in investor psychology. During growth-dominated cycles, risk is framed as opportunity. During rotation phases, risk is reframed as exposure. This shift changes portfolio construction, hedging behavior, and capital allocation models. Hard assets benefit because they offer optionality against systemic outcomes, while growth equities are penalized for their sensitivity to macro variables beyond corporate control. Silver's rise reflects this recalibration happening in real time. This rotation also feeds on itself. As growth assets underperform, relative returns reinforce defensive positioning. Performance-driven capital, such as institutional mandates and algorithmic strategies, adjusts exposure based on trend persistence. This accelerates outflows from narrative-driven assets and deepens the bid for tangible stores of value. What begins as a strategic hedge evolves into a dominant market theme. The most important hook is this: capital rotation is not a temporary trade, it is a regime signal. When silver sustains strength, it suggests that investors are no longer confident that policy support and liquidity will restore previous valuation norms. Growth narratives lose their premium because certainty has replaced optimism as the scarce asset. In that environment, markets reward what endures, not what promises, and the consequences for valuation-driven sectors unfold with relentless logic. History rarely repeats in exact form, but in financial markets it rhymes with uncomfortable consistency. Strong advances in silver have repeatedly appeared before periods of elevated equity volatility, not as a coincidence, but as an early stress signal. Silver reacts to shifts in monetary trust and liquidity conditions faster than earnings reports or economic data. The hook most investors ignore is that by the time volatility shows up in equities, silver has usually already done its job of warning. In previous market cycles, silver began rising during phases when risk assets were still performing well and optimism remained intact. These were moments when structural imbalances were building quietly beneath the surface. Equity markets, driven by momentum and liquidity, continued higher until a catalyst exposed the fragility created by leverage and valuation excess. Silver's advance in those periods was not predictive in a technical sense, it was reflective of underlying stress that had not yet found expression elsewhere. What makes silver particularly effective as a barometer is its dual role as both an industrial and monetary asset. It responds to real economic demand while also reflecting currency confidence and inflation expectations. When silver rises aggressively without a corresponding surge in industrial activity, the signal shifts toward monetary stress rather than growth optimism. That divergence has historically aligned with upcoming volatility in financial assets, especially equities priced on stability and predictability. Equity volatility tends to cluster, and silver's role is often to mark the transition from complacency to uncertainty. As silver strengthens, implied volatility measures remain subdued initially, creating a false sense of security. The hook here is psychological. Markets underestimate risk precisely when it is transitioning from dormant to active. Silver moves during that transition, not after it. Another recurring pattern is timing asymmetry. Silver does not tell investors when markets will break, but it consistently tells them when conditions are becoming unstable. This asymmetry is why the signal is often dismissed. Investors prefer precise forecasts over probabilistic warnings. Yet market history shows that ignoring early stress indicators leads to reactive decision, making once volatility erupts. The deeper historical lesson is not about silver itself, but about how markets process risk. Hard assets rise when confidence becomes conditional rather than absolute. When that shift occurs, equity markets lose their margin for error. Volatility is no longer an anomaly, it becomes a feature. Silver's breakout marks the moment when stability is questioned, leverage is re-evaluated, and risk is repriced across assets, even if the consequences take time to fully unfold. So if you're waiting for official confirmation, for permission, for headlines to turn red, you're already behind. The signal has spoken. Silver has spoken. And when the most honest asset in the system starts shouting, the smartest move is not denial, it's discipline. Because in markets, just like in life, the greatest damage isn't done by the crash itself. It's done by refusing to believe the warning that came before it.